Welcome back to Facts Matter, a production of the Citizens Research Council of Michigan, where we explore important policy issues facing our state. I'm Mark Bayshore. There's been a lot of debate lately about the future of Michigan's income tax rate. After 2 months of speculation, State Treasurer Rachel Eubanks officially confirmed in late March that an automatic trigger added to state law in 2015 would lower the state's income tax rate from 4.25% to 4.05% for fiscal 2023. But Attorney General Dana Nessel now says that rate cut will only last for 1 year, setting off a firestorm in Lansing among legislative Republicans who insist that the increase should be permanent. CRC Senior Research Associate Bob Schneider took a deep dive into the arguments, and he joins me now. Bob, for starters, explain to us how this 2015 law change, how that happened and how that plays into this dispute.
Right. So folks may remember in 2015, the legislature tried to tackle road funding issues and to generate some additional revenue for road repairs and road maintenance. That listeners may recall, we had a gasoline tax increase of about 7 cents a gallon. We had an increase in the annual registration fees we pay to the Secretary of State. They went up by 20%. Some current revenue from the income tax was dedicated to the roads. So we raised taxes, and we also looked inward and redirected some existing revenue. But in the end, that was still, those tax increases were tough votes for at that time a Republican-led legislature. So some Republicans were still hesitant to vote for some of the tax increases, particularly the gasoline tax. So in the end, as part of the final deal, this income tax trigger mechanism was also added to that package. And basically that says that whenever the law says that whenever general fund revenue, that's the state's discretionary revenue, whenever that goes up significantly faster than inflation, then this trigger will automatically reduce the income tax rate. The law basically sets up a formula to calculate capped general fund revenue based on historic general fund revenue and inflation. Here's a cap on general fund revenue. And then each year it prescribes, okay, look at actual revenue, compare it to this calculated cap level. And if actual revenue is higher than the cap, then the income tax rate falls. If we have, for instance, $700 million in excess revenue above the cap, then the income tax rate falls by an amount that is expected to reduce revenue by $700 million and eliminate the excess. So when that happened, many people thought we'd probably not see this trigger actually be activated. But in fiscal year 2022, we had a real surprise, a lot of extra general fund revenue that most folks weren't forecasting. So all of a sudden, in January, it became apparent that actual revenue was going to exceed this cap, and that's what got us here to this point, that this income tax rate will now officially fall from 4.25, as you said, Mark, to 4.05%. That's the big picture of that trigger mechanism that we're talking about.
It sounds as if the AG's analysis is focused on the importance of two words, those two words, current rate. Is it fair to look at it that way?
Yeah, so that is an important element of the interpretation of the law, and that's what that's the heart of this right now. The law sets up an annual process to look at whether the income tax rate should fall, as we talked about with this trigger mechanism. But the law specifically says that each year the current rate should be adjusted by an amount determined by this formula that we just talked about. But it doesn't define in the law what current rate means. Does it, how do we define what is the current rate? I think lawmakers from 2015, and I think many, Republicans today have said, look, when we current rate, we mean whatever the rate is, whatever the reduced rate was. If the rate goes down 1 year because of this trigger, then the current rate is the new reduced rate. And we expect that to go on indefinitely. The Attorney General's opinion looked at that definition of current rate and said, current rate means the rate that existed when this law was passed, and that rate was 4.25%. So it envisions a process that the starting point for any rate reduction each year would be 4.25%, that existing rate. If we have a rate reduction as we're about to have here that's triggered for 1 year, that doesn't necessarily carry forward. It would go back to 4.25% the next year, and then we determine separately now whether there's another reason to reduce it, under this formula. But basically, the Attorney General's opinion says the starting point, the current rate, is 4.25%, and that's our starting point every year. And in our analysis, if you look at our blog, we think there is room for debate there. I think folks that say, what, next year when we make this determination, the current rate will be the reduced rate. It'll be 4.05%. There's probably an argument to be made there that you can make a strong argument that the current rate should actually be 4.05% next year. So we think that part of it at least is ambiguous.
So your analysis actually disagrees with her on that element, but you agree with her overall conclusion. What are you seeing in the law that leads you to that conclusion then?
Yeah, so that's the other part. And the Attorney General's opinion talks about this, but it's not their emphasis. The section of the law that's important here has two important little subdivisions. The first subdivision, says the rate now and in the future shall be 4.25% in any year. And then it says, except when this other little section of law says something different. So then if you go to that section of the law, it says there's two parts to that. And it says, one, each year, if general fund revenue grows faster than inflation, if that happens, then then go about computing all this capped general fund and comparing it to actual general fund revenue and discern whether a rate cut is necessary. What we know almost for sure next year is general fund will not grow faster than inflation. We had a sort of an unusual fiscal year 22 where revenue was really high. Without anything else, that's expected to fall next year. General fund's going to fall closer to trend next year. And Mark, as you and listeners know, we just had a big set of tax reductions passed in legislation. Not only is the income tax going to drop due to this trigger, but we had changes in the treatment of retirement income that's going to reduce revenue. We have changes in the earned income tax credit that's going to reduce revenue. So these tax cuts plus the decrease in natural revenue is going to mean general fund is going to be growth is going to be negative next year, and it's certainly going to be below inflation. So that means the if is false, and that section does not say, nothing in the law says if general fund growth is slower than inflation, then here's what to do. All it says is if it's faster than inflation, then do this trigger calculation, and it's silent on what to do if not. So then I think a plain reading of that language then is you go back to that first section that says it's 4.25% unless something different is prescribed over here. Nothing different is prescribed in that section. So our analysis says, and our interpretation is it should go back to 4.25%. And I think that's a clearest reading of the language that we come to.
Your analysis also acknowledges that in 2015, the Republican majority fully intended this kind of rate cut to be permanent. In fact, both the House and Senate fiscal agencies, which are nonpartisan, both presumed that. Your paper states that it's, quote, abundantly clear, unquote, that the legislature in 2015 meant for this trigger provision to result in permanent reductions to the income tax rate. So what happened? Why should the rate still go back up?
Yeah, so it is very clear. We looked at this legislation back in 2015 when it was happening. It's really clear that the legislature intended whenever this trigger is activated that it would produce a permanent a permanent rate reduction. It's it's becoming very clear that the language used to do that was flawed. I don't think the language in the law reflects the intent of the legislature at that time in 2015. And it's a flaw in that language that, when you sit and read it carefully and as clearly as you can, that suggests that, that this is a one-time cut and that the rate would go back up to 4.25% in 2024 when we get to that point. So, the intent was clear, the language was flawed, and that's what creates this this problem for those who are proponents of a permanent tax cut.
Revenue projections strongly indicate that the perfect revenue storm that you alluded to earlier that triggered the upcoming income tax rate won't be repeated. How important is that?
Yeah, it is important. So we talked about fiscal year 22 revenue, and that's what we compared to 22 general fund revenue to this cap. It was really high, and part of the reason it was high, the thought of many of the forecasters and economists who work on the projections, is we had some changes to tax law related to how certain partnerships and S corporations are taxed, a new flow-through entity tax that we don't need to talk about the details of, but there was a new method for taxing at the business level, business income, and it seems like that that generated some additional revenue that would not otherwise have happened. And we also just had a continued growth in the economy. Again, as we talked about, that naturally is going to fall in 23, and adding on all the tax reductions that were recently passed, we're gonna probably see revenue in 2023, general fund revenue maybe $1.5 to $2 billion below fiscal year 2022. And if we look out a few more years, that probably even gets a little bit worse. So in all likelihood, this is a one-time triggering of this rate cut mechanism that was put into law. If we look, over the next 10 years at least, and maybe forever, this trigger probably becomes sort of a irrelevant issue. I don't think we're going to see an income tax rate cut triggered again anytime soon, meaning even in the next decade or so, because we're going to be $2 to $3 billion below that capped level that's based on inflation that's calculated every year. And like the revenue limit, the state has a revenue limit in its constitution, and it's sort of been moot for many years. We've been 10, 11, $12 billion below it. Probably the same thing happens here, where we're not going to see a triggered rate cut again for a long, long time, if ever.
Since the AG's opinion was released, many who support a permanent rate cut have argued with its logic, with particular disagreement about that term, current rate, that was used in the 2015 law. This includes many in Michigan's business community, like former Lieutenant Governor and current small business head Brian Calley. Are they wrong? And is this case headed to court?
So, those folks are very much right about intent. It's very clear what the intent was in 2015. It was to create, to trigger permanent rate reductions in the income tax. They also may well be right about that ambiguity of the definition of current rate. I think they can make an argument in a court case. I think you could try to argue, current rate, it doesn't mean the original rate of 4.25%. It means whatever we've reduced it to over time. They can make that case, and maybe that sticks. I can read it that way. But the issue that hasn't, I think, been discussed is this as much is what we're reading as this sort of trigger, this event, this if statement. General fund revenue is definitely not going to grow faster than inflation for fiscal year 2023, and because of that, all of those calculations, what does current rate mean? What is the cap general fund level? None of that matters as we read the language. None of that matters anymore. So that's not the key point to us, at least. That's not the key point. It's that general fund is going to grow much slower, probably negative growth compared to inflation. And so this whole issue goes away. And the only interpretation we can make is the rate goes back up then to 4.25% next year. And I think you say, will the case go to court? It seems likely, but I think any litigants then in that case are probably going to have a pretty high bar to clear to convince to convince a judge, to convince a court that that the rate should stay at 4.05%. We think the language is pretty clear in regard to that if statement. You know, if general fund grows slower than inflation, which it surely will, the rate goes back up to 4.25%.
This is all very interesting and extremely relevant. Bob Schneider is a senior research analyst with the Citizens Research Council of Michigan. They are online at crcmich.org and on Twitter at crcmich. I'll point out that the not-for-profit Citizens Research Council of Michigan marks its 107th birthday this month. That's a good long time that the CRC has provided factual, unbiased, independent information on significant issues, all with the aim of good state and local government here in Michigan. You can find a link to donate to the Research Council at the CRC website, crcmich.org. A fact tank cannot run on fumes alone. This has been Facts Matter, a podcast presentation of the Research Council of Michigan. Thanks again, Bob.
Thank you. Thanks. Good to be with you, Mark.